I've been at this game long enough to know that the market doesn't pay you for activity. It pays you for judgment. Most men who come into speculation think the trick is to always be doing something. They feel naked if they're not in the market. They think sitting still is the same as falling behind. But that notion is what ruins more accounts than bad tips or crooked brokers ever did. The truth is simpler and harder to swallow. Most market conditions demand restraint, not action. And survival, real survival, depends on learning how to do nothing, and do it well. Let me ask you something. When you look at a chart and nothing is clear, whose fault is that? Is it the market's job to entertain you, or is it your job to wait until it speaks plainly? The market does not operate on your schedule. It never has. It moves when it's ready, and it rests when it's tired. Most of the time, it's resting. Yet the public insists on forcing trades out of dull, sideways movements, as if price owes them a living. I learned early that money is made by sitting, not by trading. That doesn't mean laziness. It means patience guided by study. There are long stretches when prices drift, when volume dries up, when the tape tells you nothing worth acting on. Those periods are not mistakes or interruptions. They are part of the business. And the man who can't endure them without pushing buttons is the man who will eventually push himself out of the game. Have you noticed how the biggest losses often come from trades you never should have taken? Not because the idea was bold, but because it was unnecessary. You traded because you were bored, or restless, or afraid of missing out. Those are not market reasons. Those are personal weaknesses, and the market preys on them mercilessly. A chart, when read properly, tells you not only when to act, but when to stay out. Most people only look for entry points. They ignore the far more important message: uncertainty. When prices chop back and forth without progress, when rallies fail to follow through, when declines lack urgency, the market is telling you to keep your hands in your pockets. Why argue with it? Why insist on being smarter than the tape? There is a dangerous comfort in constant action. It gives the illusion of control. You feel like a participant, like a professional. But the market doesn't reward appearances. It rewards alignment, and alignment only occurs at certain times. Trends are rare, clear opportunities are fewer than people think. The rest is noise, and noise is expensive to trade. I've always said that speculation is a business, not a pastime. Any business has overhead. In trading, your overhead is mistakes. The goal is not to eliminate them. That's impossible. But to reduce them. One of the simplest ways to do that is by not trading when there is no edge. Yet how many men blow up not because they were wrong, but because they were early, late, or unnecessary? Let me put it plainly. Cash is a position. It's not a failure. It's a choice. When conditions are wrong, being in cash is the most intelligent trade you can make. It preserves your capital, and more importantly, it preserves your mental clarity. A trader with a clear head can act decisively when the time comes. A trader who has churned himself into confusion cannot. Do you think the big moves announce themselves every day? Of course not. They come after long periods of waiting. Accumulation is quiet. Distribution is subtle. The man who survives is the man who waits for confirmation instead of anticipation. He doesn't guess bottoms or tops just to feel clever. He lets the market prove itself. Most traders confuse effort with progress. They think more trades mean more chances to win. In reality, more trades usually mean more commissions, more stress, and more opportunities to be wrong. The market is not a slot machine. You don't get paid for pulling the lever. You get paid for knowing when not to. There's also a matter of temperament. Some men are constitutionally unsuited to speculation because they cannot sit still. They need action the way others need air. The market exploits that hunger. It dangles small moves, false breakouts, little flurries of excitement, and the undisciplined trader bites every time. He mistakes motion for meaning. Have you ever watched a stock move all day and end exactly where it started? That's the market laughing at impatience. The chart reader's real skill is not prediction, but recognition. Recognition of when conditions are favorable, and when they are not. Most conditions are not. That's the part nobody likes to hear, but it's the truth. Trends are the exception, not the rule. And fortunes are made by pressing hard during the exception, not by grinding away during the rule. Restraint is not passive. It's active discipline. It's the daily decision to protect your stake. Because without capital, you have no future in this business. Survival comes first. Profits come second. Any man who reverses that order won't last long enough to matter. Ask yourself this the next time you feel the urge to trade: what is the market offering me right now? Is it clarity or is it confusion? If it's confusion, why should you pay for it? The market will still be there tomorrow. Your capital might not be if you insist on fighting it today. I've seen markets that were generous and markets that were cruel. The generous ones came after long periods of boredom. The cruel ones came when people thought they could force results. Doing nothing, when nothing should be done, is not weakness, it's professionalism. Impatience is one of those things that never announces itself honestly. It doesn't walk into your trading room and say, "I'm about to cost you money." It disguises itself as confidence, as decisiveness, as the feeling that you're finally getting the hang of things. And that's why it's so dangerous. On the chart, impatience leaves fingerprints that are easy to recognize after the damage is done, but almost invisible when you're in the act of pulling the trigger. Every unnecessary loss I've ever taken could be traced back to impatience. Not bad analysis, not ignorance of the trend, but the simple refusal to wait. The market wasn't ready, but I was. And that mismatch is where money leaks out of an account. The chart didn't lie to me. I just refused to listen to what it was saying at the time. A patient trader waits for the market to confirm his thinking. An impatient trader demands the market confirm his feelings. That difference shows up in where trades are entered. Look at a chart after the fact, and you'll see it plainly. The patient entries sit near breakouts, near points of expansion, near moments when price and volume agree. The impatient ones are scattered in the middle of ranges, right into resistance, or directly against the prevailing trend. Have you ever entered a trade and felt relief instead of confidence? That's impatience talking. Relief comes from finally doing something, not from doing the right thing. And the market has a way of punishing that kind of emotional release. It doesn't care that you were tired of waiting. It doesn't care that you felt due. For a trade, impatience shortens your vision. Instead of seeing the whole structure of the market, you fixate on the last few bars. A small uptick feels like the start of a move. A minor pullback feels like a bargain. But when you zoom out, you realize nothing meaningful was happening at all. The loss didn't come from the chart changing. It came from your time frame shrinking. Most traders don't lose money because they can't read charts. They lose because they read them too fast. They rush interpretation. They see patterns before they're complete. They act on setups that haven't earned the right to be traded yet. The chart is a story, and impatience makes you interrupt it mid-sentence. Think about how often impatience pushes you to anticipate instead of react. Anticipation feels smart. It feels like getting ahead of the crowd. But in most cases, it just means stepping in front of a train that hasn't even left the station. The market moves in phases, and impatience ignores those phases entirely. It wants results now, not structure. There's also a subtle way impatience shows up after a loss. Instead of stepping back, you lean forward. You want to make the money back quickly. You start seeing setups everywhere. The chart hasn't improved, but your urgency has. That urgency tightens stops, forces entries, and turns small losses into strings of them. On the chart, this looks like death by 1,000 cuts. Have you noticed how the worst trades often come right after you've been sitting in cash too long? You start to feel like you're missing something, like everyone else is making money without you. That's impatience dressed up as market awareness. The chart hasn't changed, but your tolerance for waiting has worn thin. Impatience also interferes with proper position sizing. When you're rushed, you don't build trades carefully. You go in too heavy too soon, before the market has proven itself. Then the first normal pullback feels like a threat instead of a healthy pause. You end up stopping out not because you were wrong, but because you were early and oversized. The market has a rhythm, and impatience is always off beat. It enters before the rhythm is established and exits before the move matures. If you study your trades honestly, you'll see that the losing ones often had something in common. They required hope to work. Hope is not a market indicator. It's a psychological crutch, and impatience leans on it heavily. A disciplined trader waits for price to do the heavy lifting. He doesn't need to be first. He needs to be right. Impatience, on the other hand, needs constant stimulation. It needs to feel involved. It confuses participation with progress. On the chart, that confusion shows up as overtrading, poor entries, and exits that come from fear instead of logic. You can't eliminate impatience entirely. It's human. But you can recognize how it translates into losses. You can see it in trades taken without confirmation, in setups forced during low volume, in breakouts bought before resistance is cleared. The chart records all of it, whether you admit it or not. If you ever wonder why a trade failed so quickly, ask yourself whether the market actually invited you in, or whether you forced the door open because you didn't want to wait any longer. Capital preservation is not a slogan you repeat to sound wise. It's a habit you either develop early or pay for later. Most traders come into the market dreaming about profits, but very few come in thinking about survival, and that imbalance is where trouble starts. Before you can make money, you have to stay in the game. That's not philosophy. That's arithmetic. The market doesn't care how good your last trade was. It doesn't care how confident you feel or how much time you've spent studying charts. If your capital is gone, your opinions don't matter anymore. You're finished. That's why preservation is the first skill, not the second. Profits are optional in the short run. Survival is not. Every rule you follow as a trader ultimately traces back to capital protection. Position sizing, stop placement, patience, selectivity, even the decision to stay in cash, all serve the same purpose. They exist to keep you solvent long enough to catch the trades that matter. A trader who ignores this truth might get lucky for a while, but luck is a poor substitute for discipline. The public tends to focus on how much can be made on a single trade. The professional focuses on how little can be lost if the trade fails. That difference in thinking shows up clearly in account curves. One is jagged and fragile. The other is steady, even boring. But boring equity curves survive market cycles. Exciting ones usually don't. Have you noticed how easy it is to underestimate risk when things are going well? A few winning trades create a sense of invincibility. You start to loosen your standards. You increase size before the market has earned it. You assume the next trade will behave like the last one. That's when capital quietly slips away, not in one dramatic loss, but in a series of careless exposures. Capital preservation also has a mental dimension that most traders overlook. When your risk is controlled, your mind is clear. You're not glued to every tick. You're not emotionally attached to every position. You can read the chart objectively because your financial survival isn't tied to a single outcome. When risk is excessive, the chart becomes distorted. Every move feels personal. There's a misconception that protecting capital means being timid. That's not true. It means being precise. The best traders are aggressive only when the odds justify it. The rest of the time, they're defensive. They understand that defense is what makes offense possible later. Without capital, there is no leverage, no opportunity, no second chance. Think about how many traders blow up not because of one bad idea, but because they refuse to reduce size during unfavorable conditions. The market changes character, but their exposure stays the same. They trade every environment as if it were trending, even when it's choppy and unforgiving. Capital preservation requires adjusting to the market you have, not the one you want. Risk is always present, but it doesn't have to be fatal. Small losses are the cost of doing business. Large losses are usually the result of neglect. The chart rarely surprises you. It warns you long before damage becomes irreversible. But you have to be in a position to listen. Oversized trades drown out those warnings. Have you ever noticed how quickly perspective returns after you cut risk? Suddenly the market looks clearer. Levels make sense again. You're no longer desperate for a trade to work. That clarity is a direct result of capital preservation. It gives you the emotional distance needed to make sound decisions. Another overlooked aspect is opportunity cost. Capital tied up in poor trades is capital unavailable for good ones. By protecting your funds, you're not just avoiding loss, you're preserving flexibility. You're keeping yourself ready for the moments when the market finally aligns. Those moments don't last long, and they don't wait for traders who are already wounded. The market has no obligation to provide equal opportunity every day. Some days are designed to take money, not give it. Capital preservation means recognizing those days and stepping aside. It means accepting that not trading is sometimes the most profitable decision you can make in the long run. Many traders confuse confidence with exposure. They think believing in a trade means betting big on it. In reality, true confidence shows up in consistency, not size. A trader who risks small and survives builds confidence through repetition and review. One who swings for the fences builds anxiety, even when he wins. Ask yourself this: if your next 5 trades were losers, would you still be in business? If the answer is no, then capital preservation is not yet part of your process. The market doesn't test you when you're right. It tests you when you're wrong, and wrong repeatedly. Preserving capital also means accepting that you don't have to participate in every move. Missing a trade is not a loss. Forcing one often is. The chart will offer opportunities again, but only if you're still standing. Over time, capital preservation compounds quietly. You don't notice it day to day, but years later it's the difference between a trader who's still operating and one who's telling stories about what could have been. The market rewards longevity more than brilliance. It favors those who last, not those who burn bright and disappear. And longevity is built, trade, by respecting risk before reaching for reward. The market does not reward constant involvement, because constant involvement has nothing to do with understanding. Being busy feels productive, but the market has never confused motion with mastery. Timing is what separates the professional from the amateur, and timing cannot exist if you insist on always being in a trade. Most traders believe opportunity is something that appears continuously, as if the market were a conveyor belt of profits. In reality, opportunity arrives in clusters, separated by long stretches of indecision. Those stretches are not wasted time. They are the filter. They remove the impatient, the overconfident, and the undercapitalized. Only the trader who can wait without forcing action is still alert when timing finally matters. Have you ever noticed how the best trades feel obvious only after they've already moved? That's because clarity comes late, not early. Timing means accepting that you will never catch the exact bottom or top. It means entering when the direction is already established and the odds are finally tilted in your favor. Constant involvement makes that impossible, because you're already committed when clarity arrives. The chart does not unfold evenly. It compresses and expands. There are periods where price does very little, followed by periods where it moves with purpose. The trader who stays constantly involved wastes energy during compression and has none left when expansion begins. Timing requires conservation. You save your focus, your capital, and your confidence for when the market is actually moving. Constant involvement also distorts your perception. When you're always in a position, every tick feels important. Minor fluctuations feel like signals. You start reacting instead of observing. The chart becomes something you fight instead of something you read. Timing, on the other hand, requires distance. You need space between yourself and the market to see its structure. The public loves activity because activity creates the illusion of participation. But the market doesn't care who is participating. It cares about supply and demand, about pressure building and releasing. Those forces don't respond to your presence. They unfold in their own time. The trader who understands this doesn't rush the process. He waits for pressure to reveal itself. Have you ever entered a trade simply because price was moving, without asking whether it was moving for a reason? That's constant involvement masquerading as awareness. Timing asks a different question: why now? Why this level? Why this volume? If those answers aren't clear, involvement is just gambling with better terminology. There's also a cost to being always involved that most traders don't measure. It dulls your sensitivity. When you trade too often, nothing feels special. Breakouts blur together. Pullbacks lose context. You stop distinguishing between meaningful moves and random ones. Timing requires selectivity, and selectivity requires saying no far more often than yes. A well-timed trade usually feels uncomfortable at entry, not because it's reckless, but because it's deliberate. You've waited. You've watched. You've passed on 10 mediocre setups. Now the market finally meets your conditions. Constant involvement never allows that moment to develop, because you're already committed elsewhere. The market rewards timing, because timing aligns you with momentum instead of friction. When you enter at the right moment, price does most of the work for you. When you're early or unnecessary, you spend the entire trade fighting noise. That's exhausting, and exhaustion leads to mistakes. Think about how often traders complain that a stock moved right after they sold or reversed right after they bought. That's usually not bad luck. It's poor timing caused by over-involvement. They were too close to the action, too eager to participate, too unwilling to wait for confirmation. Timing also protects your mental capital. When you're selective, losses don't pile up emotionally. Each trade has meaning. Each result teaches you something. Constant involvement turns trading into a blur of outcomes with no clear lessons. You're too busy managing positions to evaluate decisions. Have you noticed how experienced traders talk less about how often they trade and more about when they trade? That's not an accident. Frequency impresses beginners. Timing impresses the market. The tape remembers when pressure shifts, not how many times you clicked a button. The idea that you must always be involved comes from fear. Fear of missing out, fear of falling behind. Fear that if you're not trading, you're not a real trader. The market exploits that fear by offering endless, marginal opportunities that go nowhere. Timing is the antidote. It requires confidence in your process and indifference to noise. A trader who understands timing knows that inactivity is not absence. It's preparation. It's study. It's observation without obligation. You're gathering information without paying tuition in the form of losses. Constant involvement pays tuition every day, whether it learns anything or not. Over time, the difference becomes obvious. One trader is worn down, reacting to everything, emotionally flat or emotionally raw. The other is calm, engaged only when the market demands engagement. Timing keeps you fresh. It keeps your judgment sharp. The market does not keep score by how often you show up. It keeps score by how well you align yourself with its movements. And alignment only happens at certain moments, not continuously. Clear trends are far rarer than most traders want to believe, and that misunderstanding sits at the root of countless losses. People come into the market expecting motion, expecting opportunity, expecting something to happen every day, but markets spend most of their time going nowhere in particular. They fluctuate, they hesitate, they test both sides without committing, and yet traders approach every session as if a major move is overdue, as if the market owes them direction. A true trend is not just price moving up or down, it's price moving with agreement. Higher highs and higher lows that hold. Pullbacks that respect structure. Volume that supports continuation instead of contradicting it. When those elements align, the market becomes readable. But that alignment doesn't happen often. It emerges slowly after confusion has exhausted most participants. Have you noticed how many trades feel like work from the very beginning? You enter and immediately have to defend the position. You justify it, manage it tightly, second guess it. That's usually because there is no real trend in place. You're trying to force movement where none exists. Clear trends don't require constant babysitting. They carry themselves. Most of the time, price is trapped between competing interests. Buyers push it up, sellers push it down, and neither side has enough conviction to take control. This creates ranges, false breakouts, whipsaws. These environments punish traders who expect trending behavior. They reward patience and punish prediction. Waiting for a clear trend is not passive optimism. It's active restraint. You're watching how price behaves around key levels. You're observing whether pullbacks are shallow or deep, whether rallies are impulsive or labored. You're letting the market show its hand before you place a bet. That waiting is the real work, even though it doesn't feel like work to those who confuse activity with effort. The hardest part is accepting that most setups you see are incomplete. They look promising, but they haven't proven themselves. The pattern is forming, but the breakout hasn't held. The trend line is there, but price hasn't respected it yet. Acting too early feels bold, but it's usually just impatience wearing confidence as a mask. Clear trends tend to appear after long periods of frustration. The market wears traders down with sideways action, failed moves, and contradictory signals. Many give up right before the structure resolves. That's why trends feel obvious in hindsight, but elusive in real time. The ones who catch them are not smarter, they're simply still paying attention. Have you ever looked back at a chart and wondered why you didn't trade the cleanest move on it? Often the answer is that you were already busy trading something else. You were tied up in noise when clarity finally arrived. Waiting for trends means being available when they begin, not exhausted from fighting the market beforehand. A clear trend simplifies decision making. It tells you what side you should be on. It tells you when you're wrong. It gives you logical places to enter and exit. In contrast, non-trending markets force you to make constant judgment calls. They drain your mental energy and blur your rules. That's why waiting is not just about price, but about preserving your ability to think clearly. Many traders believe they are trend following, but their results say otherwise. They trade too frequently, exit too quickly, and reverse too often. That behavior belongs to range-bound markets, not trending ones. A real trend allows for breathing room. It allows for patience within the trade itself. There's also a psychological shift that happens when you stop expecting trends everywhere. You stop feeling cheated by the market. You stop blaming yourself for not finding opportunity on quiet days. You accept that dull periods are normal. That acceptance removes pressure, and pressure is what leads traders to manufacture trades that don't belong. Waiting for clear trends also changes how you measure success. Instead of counting trades, you count alignment. Instead of daily excitement, you look for structural progress. This mindset favors long-term survival over short-term stimulation. It aligns you with how the market actually behaves, not how you wish it behaved. Have you noticed how trends often begin quietly? There's no announcement, no dramatic candle, just a subtle change in character. Pullbacks stop going as far, breakouts stop failing. Momentum starts to persist. These are not signals for the impatient, they are invitations for the observant. The trader who waits understands that missing a trend is less damaging than forcing participation before one exists. Capital lost in chop is capital unavailable when the real move begins. Energy wasted on noise dulls your response to clarity. Waiting is not about perfection, it's about readiness. Clear trends don't need to be chased. They unfold over time. They allow late entries. They forgive small mistakes, but only if you recognize them as rare events worth focusing on. Treating every fluctuation as a trend cheapens your attention and spreads your risk thin. The market does not reward eagerness. It rewards alignment. And alignment requires that you accept how infrequently everything lines up. The trader who understands this stops asking when the next move will come and starts asking whether the conditions even exist for one to matter. Most days are not designed for bold decisions. They are designed to test your discipline. Waiting for clear trends is how you pass that test, how you protect your capital, and how you position yourself for the moments when the market finally stops hesitating and chooses a direction.